In this video, we will talk about Mullen, trading under the ticker symbol MULN. Before we start today's video, if you like my content, please consider to like, comment, and subscribe to my channel. Mullen recently made headlines with the initiation of a stock buyback program, an action that has triggered curiosity and also a lot of concern within the investor and shareholder community. The company's move to repurchase about $3.6 million worth of its own stock as of August 16, 2023, has triggered mixed reactions, leaving many uncertain about the potential impact on the stock's trajectory. Well, actually, we pretty much know where it's going to go. I'm just leaving things more open-ended. So this buyback initiative has arrived at a very critical juncture for Mullen, because it needs to lift once again. This is like the third time within 6 months. It needs to lift back its stock price above $1 to maintain compliance with the NASDAQ regulations. The company's shares are currently trading at a very modest, like 72 cents, which casts a lot of doubt on whether the buyback alone can just prop up things above $1. One noticeable sign of confidence does come from Mullen's own CEO, David Mitchery, who personally acquired about 102,000 shares. Of course, the success of his endeavor also hinges on the company's ability to overcome many of its own hurdles. So the NASDAQ compliance timeline adds to the urgency of Mullen's situation. Things are critical at this point. They need to achieve the stock price of $1 for 10 to 20 consecutive days by September 6th, potentially with an extension of 180 days once this happens. Now, this feat requires the buyback to succeed, but also to have a potential shift in the market sentiment and the trading dynamics. None of which we're seeing, by the way, if I may say so. So, the stock's performance has been very closely scrutinized by the short sellers. They have taken up an additional short position of around 14 million shares. Of course, the signals from that part has proven to be a very mixed exercise, reflecting the ongoing uncertainty more than the certainty that things are going to go worse, if it makes sense. It means that there's more chaos in the whole mix, but we don't know where it's going to go next, necessarily just from the short size. Now, the recent trading activity has painted, again, a pretty bad situation, with the stock shredding around 9% of its value within a single day, a decline that has lasted through the entire trading session. The trading volume has also been significantly lower compared to prior days when the stock was more actively traded. Institutional investors are placing in their bets on the company. So the two noticeable ones are Vanguard and BlackRock. So they, like many other companies such as Geode Capital Management, Sigma, State Street, they still hold some positions in the company, but again, their exposure is so low that it's negligible. And this is why they don't really mind if the stock goes to to a very low level compared to their cost basis. So their presence does add a layer of complexity to the future price action, because the actions can influence the market sentiment and to create cascading effects. So to address the current compliance issue, Mullen took a very proactive step by initiating a stock buyback program that's worth around $25 million, spanning from August 16 to December 31st of this year. Dave Mitchery's personal investment of 200,000 shares at 98 cents per share. Oh, okay, sorry. So I made a mistake a few moments ago. Yeah, so he didn't just put in 98 cents for the entire position. He bought them at close to like 200K. That's a pretty noticeable highlight of the program, but it might just be a tiny drop in a ginormous bucket. So the subsequent drop to like 70 and maybe 60 cents has to be followed up like very closely. Hopefully it's gonna stop, but I'm not fully convinced at this current stage. We also need to see another phenomenon that I'm not seeing right now, judging by the volume, which is the rallying of retail investors. The stock's subpar performance calls for a collective phenomenon or a collective effort. The counter like the current short selling current short selling phenomenon. And I'm not sure that as a collective we have the strength, or more importantly the faith, to go through this again. Now, there is frustration directed at the CEO and also the current conjunction about the company's ability to bounce back is moderate at best. As speculation and concern does kind of, occupy most of the market, the need for additional clarity, transparency, and effective communication are key. However, I think that these are precisely the things that cannot be provided. That's like the main issue at the moment. And I guess we can all imagine why, right? I mean, it's pretty self-explanatory. They cannot tell us everything they know, because otherwise there won't be a market ready to support what's left of this company's value. And I think that to a certain degree, investors also feel very similarly. They don't want to completely rock the boat, especially the people who have put a very significant chunk of their portfolio into this stock in particular. So, of course, the root cause of this decline can be traced back to the substantial shorting activity. And that also has been fueled by the previous attempts to artificially boost the stock price with reverse stock splits. So short sellers have shown that their dominance is very evident, and it's now taking a significant chunk of the volume off the exchange. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions instead of choosing ETFs. So, my conclusion regarding Mullen for the time being is to be very careful and to maybe stand on the side to watch whether things can maybe calm down a little bit, settle down a little bit, and hopefully we're going to be able to make better decisions once like the worst of the storm passes. If right now it's even the worst to begin with, but I certainly wouldn't recommend to buy more Mullen shares as things stand now.